thank you for joining us, everyone. I have 2 o'clock by my watch, so we're going to get started. Welcome to the MCF General and Investment Updates for March 5th, 2019. Just a few quick housekeeping items. You can press *6 to mute your line, and we would appreciate for those folks who won't be speaking to go ahead and do that. If you're here to listen, you can press *7 to unmute your line. You can use the chat function during the webinar, but we'll be having a question and answer section at the end if you'd rather hold your questions until then. And as you may have just heard, the webinar is being recorded. We will have that available to you on our website in the next couple days if you want to revisit anything, and also for those folks who weren't able to join us today. Is everybody ready to get started? If so, I'll hand it over to Mary Rutherford, and she'll be doing a general update.
Thank you, Riley. We appreciate you all patching in today. Obviously, some of us are experiencing a little bit colder weather than others. Yesterday it was 36 below zero at my house and 25 below zero here at the office. So I appreciate all of you plugging in. I hope you're home in a nice, warm, cozy location, or at least cozy at your office if you're in the office today. Omar, I just had to tell you those temperatures because I'm pretty sure that's not what you're experiencing where you are.
You are correct.
With that, I always love the opportunity to kind of give you, all of you who call in, just a quick overview or some information of things that are happening here at MCF and a perspective of what's on our minds these days and things that we're working on before we go into the investment portion of our conversation. First and foremost, you all know that at the Montana Community Foundation, we are absolutely focused on Montana's future and focused on preserving the things that we love and care about here in Montana, and we're focused on forever. So this is a big time of year for us because we just completed our endowment payout distribution process, and which is kind of the culmination of, frankly, many years worth of work, but what happens in our organization over the course of the year to make sure that those distributions go out to benefiting organizations by March 1st. And I'm happy to tell you that this year we awarded or distributed just over $3 million to 640 different recipients, mostly across our state. And so we're really pleased to be able to be part of that process and part of the participants in making sure that the things that we love and care about are preserved here forever. Another component of that, of course, as it relates to endowment building here in Montana, is our great Montana Charitable Endowment Tax Credit. And some of you may or may not realize that that tax credit is set to expire this December 31st. And so we've been really proud to be partnering with our friends at the Montana Nonprofit Association in working to get that tax credit renewed. The Charitable Endowment Tax Credit has passed the Senate, and it's now set for a hearing with the House Tax Committee, and will be working its way through the House and then hopefully going to the governor's office to be signed. So that's another big, important area of our work for us these days in this legislative session. Typically we aren't heavily engaged in public policy or legislative work, but the tax credit's one that really matters to Montanans in terms of endowment building. So we're happy to be part of that process. I guess thirdly, part of our long-term approach for our focusing on Montana's future is our investment philosophy and the decisions that our investment committee makes relative to ensuring that the purchasing power of funds today are as strong 20 years from now as they are today. So we're really proud of the relationship and our partnership with Cambridge Associates. And we have joining us today Omar Sanchez, who's our Chief Investment Officer. He has really done a wonderful job of working with our investment committee to help us remain focused on our long-term philosophy for our endowment. And so with that, Omar, I'm happy to just turn it right over to you. Thanks, everyone.
And thank you, Mary. Thank you, as always, for the opportunity. It's always great to get together with the committee and then obviously get the opportunity to talk with individuals as well in the broader constituency for the foundation. When you mentioned the temperatures that you're experiencing, I felt a lot better about the 12 inches of snow that we got yesterday. So I feel for you, and I hope that it gets warmer very soon. There were really three topics from our perspective, my perspective, that we wanted to cover today in terms of an agenda. The first would be just a brief refresh on who we are, who is Cambridge Associates, for those that may or may not be less familiar. Secondly, a step back again and a review of our investment approach. Always think it's helpful. We do this at every single meeting with the committee, just reviewing our philosophy on investing, because it really does drive how we think about making the decisions that we make on your behalf, and it really just provides helpful context. And then the third, perhaps of most interest and most important, we will review briefly recent market action as well as an update on performance for the portfolio, both for shorter periods and since we've been working together. So starting with Cambridge on the next slide, this is a very brief overview of what we think are some important details about the firm. Cambridge Associates is a global investment management firm. We were founded in the mid-'70s by two alumni from Harvard, Jim Bailey and Hunter Lewis, who essentially started really the first project and the first work for the firm was a research project for the broader university. And ultimately, if you fast forward several decades later, today we work with a range of different endowments and foundations, with pensions, private clients, governments, as well as some insurance companies, to help these individuals, help these clients manage their investment portfolios, and ultimately help them achieve their goals, their missions. If you turn to the next slide, I'll spend a moment there in terms of the team. As Mary said at the outset, I am the Chief Investment Officer for the Foundation. I am part of what we call CA Capital Management. This is our outsourced discretionary investment management business. Again, I am the CIO for the Foundation as well as some other clients, and together with my team, what I do is effectively manage the portfolio, making all the investment decisions, whether it's hiring or firing managers, rebalancing the portfolio, making what we call more valuation-based tilts relative to policy to try to ultimately generate the returns that this portfolio needs to achieve its long-term goal of growing its purchasing power. And this is all done within the context and within the rules, if you will, or the guidelines that are set by the investment committee, which we review on an annual basis to make sure they continue to be appropriate within the context of your broader operating environment, within the risk tolerance of the committee and the portfolio. And what I would note is that it's not just me and my direct reports in terms of the individuals that help me identify these investment opportunities, which are the individuals you can see across the top of the page, but I also have the benefit of working within a global investment management firm in terms of a very fully resourced operations team to help us implement all the investment decisions that we make. And most importantly, I would argue, is our global research platform. These are individuals charged with one job, and that is to ultimately find the best managers not only of today, but ideally of tomorrow, and get our clients access to them. And I think we've had a lot of success in that regard, working together with the Foundation to do that, and this is going to be the engine that's going to allow us to continue to do that going forward. So with that, what I wanted to do then is, again, take a step back and briefly review the investment philosophy. And it really is grounded and driven by a long-term investment horizon. Day to day, quarter to quarter, there will be a lot of noise in the markets. We are aware, acutely aware of what's going on in markets. But we also know that to be successful, we need to take the long view and we need to have an investment strategy. And this is not an investment strategy that's designed to avoid the next bear market or fully avoid very difficult markets. It's an investment strategy that's designed to help us withstand those more challenging market environments so that we maintain exposure, so that we don't sell, and so that we can participate when markets recover. And so that's why we spend a lot of time at the beginning of the relationship, whether it's with the foundation or with our other clients, understanding both the ability of the organization to take risk as an organization, as an institution, and the willingness to take risk among the key stakeholders, in this case particularly the investment committee. And then we build a portfolio that's aligned with that so that we make sure we're building a portfolio that has the right investment strategy and a portfolio that is right for you as the foundation. We absolutely believe in using active management when we have a high degree of confidence that we're going to get paid for doing so, net of all fees and expenses. And if we don't have that confidence, we're more than happy to have index exposure or passive exposure, and we do have a fair amount of passive exposure in the portfolio today. However, again, what I would say is if we think we have a high degree of confidence in getting that value added, then we're absolutely going to do it. We do not market time. I want to be very clear on how I define that. My definition of market timing is making significant shifts in capital in the portfolio based on a view of the near-term direction of markets. That is not something that we believe leads to long-term success. In fact, we believe it can lead to capital impairment. We have yet to find an investor that can do that well, consistently. And that's just not our competitive advantage, so that's really not where we're going to focus. We will make modest tilts relative to our long-term strategic asset allocation. So if we think that valuations are a bit more at extremes, we think that we're finding more opportunity in non-U.S. markets relative to U.S. markets, for example, which happens to be the case today, we will modestly underweight, in that example, U.S. markets and modestly overweight non-U.S. markets to add incremental value. But it's not going to be the main driver of our value added over time. Ideally, that is going to be manager selection, meaning picking managers that over the long term can outperform their benchmarks net of fees. And then the last element, which is of course very important, is risk management. This is not a tool, it's not a model, if you will. We've got plenty of tools and plenty of models, I assure you, but it's really a process, it's really a mindset. It starts, again, at the beginning of a relationship where we work with, in this case, the foundation, to understand that ability and willingness to take risk, to understand and be aware of any sort of constraints that might impact the investment portfolio, and then reflecting the long-term strategy in a set of long-term strategic asset allocation targets and ranges, benchmarks, position size limits, you name it. It's really the guardrails that we have. It's our rule book to then go out and actually build the portfolio. And when we build a portfolio, of course, we're very focused on diversification to reduce risk, to ultimately deliver a more consistent return over time. And it's diversification across strategy, across style, cap, sector, as well as diversification across sources of return. And so that's another form of risk management. We are very thoughtful in how we size positions in the portfolio. We want to make sure that no single position determines success or failure. And so we think very rigorously about how a given manager in the portfolio should be sized, given our expectations for their performance profile, for their value-added profile, and we reflect that in how we size those managers in the portfolio. And then the last piece, of course, is just day-to-day management and oversight of the portfolio, understanding how we're positioned relative to policy, understanding our level of market exposure, understanding the bets that we have in the portfolio, and to the extent that we have any bets that are unintended, working very hard to mitigate those bets as best we can. But again, the bottom line with risk management is that it's comprehensive, it's holistic, and it's really integrated into everything that we do. So then, how do we build portfolios? And this is relevant when you see how the portfolio is currently allocated today. For, I would say, the majority of our clients that are similar to the foundation, that they're trying to grow the long-term inflation-adjusted value of the portfolio over time, we believe in having equity-oriented portfolios, both public equities and private investments. And in both of those categories, the name of the game is return. We're hoping to get, that's really going to be our growth engine in the portfolio. And so the public equities are going to drive that growth. Historically, they've been a higher returning asset class relative to cash and bonds. And then the private investments, the illiquid partnerships, those are even higher returning assets, and those are really going to drive the growth in the portfolio. But we know that if we have a higher equity-oriented portfolio, what that means is that there's going to be greater volatility, all else equal. And so what we use are what we're referring to as diversifying strategies to help reduce risk and increase diversification in the portfolio. And so this is a broad category that would include things like your traditional long-short equity hedge funds, event-driven multi-strategy hedge funds, as well as some strategies that actually can be more liquid and less correlated that can play a similar role in the portfolio. But the overall idea in using these investments is to reduce total portfolio risk and ideally not give up as much upside as if we were to just use bonds to play that role. And then the final component, I'm going to combine the inflation and the deflation hedging component here. We really think of that as a liquidity allocation, if you will. That allocation in aggregate is meant to help support spending during periods when equities are likely not to perform well. The two types of scenarios that we're most concerned about, one, a period of severe, unexpected inflation, and so we have assets that are designed to appreciate in those environments to help support spend. And then the other scenario that we are worried about, again, that can impact equities adversely is deflation, recessions, significant economic contraction. And so in that allocation, we'll hold primarily Treasury bonds, and depending on kind of where rates are at a given point in time, we may tilt a little bit by holding a little bit of cash. But the key driver there, the key role there, is to help support spending so that you don't have to sell other parts of the portfolio that are likely selling at more depressed valuations. So those are really the key building blocks in the portfolio. Why do we diversify? This is a great chart that we like to use with the committee and with our other clients. We refer to this chart as the quilt. What this is showing you are the best and worst performing asset classes top to bottom across asset classes since 2004. And we've color-coded it by the different asset classes to make the point that in any given year, that year's winner could ultimately become next year's loser. And so from a risk management and an investment perspective, we clearly don't think it makes sense to load up too much of the portfolio on any one given asset class, because when it doesn't work, it can really not work. Rather, we would rather spread our bets across the portfolio across these multiple sources of return, because if we can do that, we will get a more consistent return over the long term. We're never going to be the best performing asset class, if you will, or the best performing portfolio, if you will, but we're also not going to be the worst performing. And over time, ideally, we're going to get a more consistent return that helps you have more consistent expectations in terms of the distributions that can be made from the portfolio. And then I mentioned earlier market timing. We are not believers in it. This is the reason, because if you do it and you're wrong, it can significantly impact the portfolio in a negative way. If you look at the chart across the top of the page, what this is showing you is the annualized compounded return of the S&P 500 over the last close to 40 plus years, close to 40 years. And what you see is over that time period since 1980, U.S. equities have compounded at 11.4%. Now, if you had missed the 10 best days, so if you were out of the market for the 10 best days over that time frame, your return would have been lower by 200 basis points. And if you had missed the 20 best days, your return would have been lower by about 340 basis points, and so forth. And while that may not seem like a lot in and of itself, it's quite significant in terms of the impact on your portfolio in a dollar basis, just given the compounding effect of returns. And so we've tried to demonstrate that here directly beneath. This is the cumulative wealth of $1 invested if you had held that money in the S&P without moving out of the market over the last close to 40 years. If you had missed these other periods in here, less 1933 as a historical example, let's basically some of these historical periods in the market, with the takeaway being you end up with significantly less money. And so this is why we really do try to take that long-term view. While we try to stay invested, we obviously want to be thoughtful about how we're positioned given the market context, but it's very important to take that long-term view and really try to resist that urge to do market timing, because long-term it can really adversely impact your ending value. So with that, why don't we speak briefly about the markets, and I can give you real-time some updated returns here as well verbally. Just a couple of highlights and context, because it will help inform the performance that we talk about for the foundation. So first off, clearly we've started the year with strong returns across most asset classes, including January, which for global equities was essentially the highest return in the record. It's 30-year record for the global equity index. And February returns have not been as high, but they're reasonably high in terms of positive, mid-single-digit positive performance. And that's important because that's a significant contrast to 2018, where it was a very difficult year across asset classes, as you can see as you look across the bottom of this page, both for equities and most other asset classes. Even bonds, where you got the best relative returns, they were quite muted, to say the least. And that's important because that performance was entirely driven by the fourth quarter of last year. In fact, if we had looked at performance for the foundation, for other clients, for the markets, through the third quarter, we were getting positive performance, decent positive performance given the market backdrop. And then along came the fourth quarter, and we had a pretty sharp sell-off. Why was that? A lot of the themes that the market has been dealing with throughout the year, throughout last year in particular, really came to a head in the fourth quarter. What we started to see were the market's concerns about slowing growth broadly, as well as slowing earnings. We started to see data support that, which had an impact on sentiment. We continued to see significant uncertainty with respect to trade and where that was going to end up in terms of the trade negotiations between China and the U.S. And the Fed struck a decidedly more hawkish tone on interest rates, particularly in December, which the market did not like at all. And so in aggregate, those were important catalysts. There were others as well, but if I were to highlight the main catalysts, those were really the main catalysts that negatively impacted sentiment, and we saw that fairly sharp sell-off that ultimately impacted 2018. So there's really nowhere to hide last year in terms of returns. And in terms of the portfolio, that obviously impacted the returns for the year, which I'll get to in a moment. But just to take a step back and look at where we stand today as of January 31st, as of January 31st, we were just under $73 million, which you can see in the donut chart on the left-hand side. Well diversified across those more growth-oriented assets between the global equities, U.S., developed ex-U.S., and so forth, as well as the private investments. And then again, having a dedicated allocation to those diversifying strategies to help bring down total portfolio risk with assets that are meant to provide liquidity in specific market environments in the commodities, tips, and treasuries. So if you look at the chart on the right-hand side, in the upper right-hand side, we started working together or managing this portfolio on a discretionary basis in August of 2016. So in terms of managing the portfolio, this is roughly at this point in time now a 2.5-year, give or take, track record. We started with $64 million. On a capital change basis, currently the portfolio is at 72.9, so net of withdrawals from the portfolio as well as contributions, we've had about $9 million in growth. That represents a 14% increase. And if you translate that to an annualized net return, and this is net of our fees and net of manager fees, that results in an annualized compound return of 5.6%, roughly tracking with the benchmark, which is at 6%. So then if we look at performance on the next slide, this is our calendar year and quarterly performance since we've been working together. You'll see where we started on the left-hand side in August of 2016. 2017 was quite a strong year, both on an absolute and a relative basis. adding close to 100 basis points of net value added. 2018, as I mentioned, challenging year. Never like to talk about down market returns, but unfortunately that's what happened. This is not unique to our clients. This is not unique to the foundation. Fortunately, because of the performance that we've gotten in January, 5.7% against 5.3% for the policy benchmark, as well as where we think we're tracking in February, at this point in time we think we've largely recovered those losses. And I think that's really important, and I think I mentioned this to the committee when we last met together. It's a great example of why we really do take that long-term view. So in the fourth quarter of 2018, volatility obviously significantly increased. We took a look at the portfolio. We looked at how the portfolio was positioned. We tried to get a better understanding of what was going on real time with the managers, and we made sure that we understood the risk profile of the portfolio as best we could at that given point in time. But we didn't panic. We didn't overreact. We held the line. We kept that long-term view, and because of that, the portfolio fully benefited when markets rebounded. And if we had de-risked the portfolio, if we had taken some risk off the table, we would have missed out on the upside that we've seen so far this year. So again, when I make that point about the long-term investment horizon, that's a perfect example of why we really try to stick to our investment strategy. Because if you don't, and you act in a different way, you can potentially miss out when markets recover, and they always do. So let's take a look at the next slide. If we could take a look at the next slide, this is the performance for the calendar year 2018, and then January of 2019 so far. Again, broadly, the portfolio's equity assets really, traded broadly in line with the markets, give or take, in terms of the performance, which contributed to the down year that we had. The diversifying strategies relative to global equity markets actually provided some outperformance. But again, it was a very challenging year, and a challenging year in an environment where really nothing did quite well, unfortunately. January is essentially sort of the reverse of that. We've gotten good absolute performance across most of the categories that we have in the portfolio. In most cases, good relative performance as well, which we were pleased to see. So again, I think with January and with February, we've largely made up the losses that were incurred last year, and we're moving in the right direction going forward, which I feel very good about and I'm happy to see. And again, that's just testament to the long-term view. The committee, when we last met together, asked some really great questions about the drivers of performance, any concerns that we had. We talked about a lot of different managers. But overall, we like what we have in terms of the portfolio today. The managers really like how they're positioned. In certain cases, when markets sold off, that actually enabled them to buy more of more attractively priced assets. And we've seen that pay off so far this year in terms of performance, which we've been happy to see. So then, if you look at the last slide, page 12, this is a summary of the investment category returns since we've been investing together. Decent story, certainly on an absolute basis across most of the categories where you're getting the most impact on performance in terms of the equities. We're getting some decent relative performance coming out of the U.S. equities and the non-U.S. developed equities. And the PI, I certainly think that's a number that warrants some additional discussion. That is the private investments that we have in the portfolio. And at our last meeting, we spent time talking about the work that we've been doing to build out to the Foundation's long-term target of 10% to private investments. We are firm believers that clients should do as much in private investments as they are comfortable and able to do, obviously prudently within the risk profile that we're targeting, because historically speaking, it's been a higher returning asset class. We have reason to believe that that higher return aspect is going to continue, and it's an area of our client portfolios where we've been able to add significant value. And so as that allocation grows, that's going to help our relative value added over time. We've had a lot of early successes in this program so far. That return is a real return. It is accurate for the private investments. It's a function of some strategies that we use that by virtue of the type of strategy actually become cash flowing more quickly. They're a way to generate some early gains from the portfolio, and we've been focusing on that as we've been building out the allocation, and those have paid off nicely. And again, longer term, this is going to be really one of the more important growth engines in the portfolio, and so we've been pleased to see the performance that we've gotten thus far out of the private investments. So overall, nothing really that outside of expectations here in terms of performance. The important thing about diversification is that at any given point in time, there are going to be some things that aren't working as well. Ideally, that's getting offset by things that are working well. That has been the case here. And over the long term, we hope we continue to deliver numbers like this, certainly on an absolute basis, and with the private investments in particular, to help increasing that value added relative to the overall policy benchmark. So those were really the main comments that I wanted to make, and I'm more than happy to answer any questions that folks have relative to the market, to the portfolio, what have you.
And Omar, I did have one question that came through while you were speaking. It says the cumulative wealth chart seems to show the time frame beginning 1/1/1900. Is it actually 1980?
Let me go back to that chart. Thank you, Riley. Right. These are actually two different time frames for this chart. The bottom chart is actually a longer term period that incorporates some additional, strong periods of market performance. The top chart is actually more recent, although 40 years is not, certainly a reasonable period of time. The takeaway is the same regardless, which is to say, if we look at this over a longer period in terms of the annualized return for the top chart, it would tell you a similar story, which is, again, when you're out of the market, when you're trying to time the market, when you miss those really good days when markets can move sharply upward, it can materially impact your returns. And that's really the point that we're ultimately trying to make with this chart on page 7.
Is there anyone else who has any questions for Omar or Mary?
The conference has been unmuted.
If there aren't any other questions, we will wrap things up. Just as a reminder, we will post a recording of this webinar on our website if any of you would like to reference it once again, and of course for those who weren't able to join us today. With that, Omar, thank you so much for the presentation as always, and we'll wrap things up and say goodbye and stay warm, everybody.